What is stock option max pain? Stock option max pain is a calculation that determines the strike price at which the most options will collectively expire out of the money on the expiration date. The opposite side of that is it's the strike price where collectively the option writers lose the least amount of money. And what exactly does that mean? Well, let's take a look at the open interest graph here on MaximumPain.com. We'll take a look at the open interest for the Apple November 2nd. And we can see here that there are a lot of outstanding put options represented by the red line and a lot of outstanding call options represented by the green line. Here on the y-axis we have the open interest, and here on the x-axis we have the various strike prices. So if the market maker had to write all these options, he actually wrote quite a few call options, and he wrote a significant number of put options, particularly below the $5.95 price for the put options and above the $5.95 strike price for the call options. Now, when the market maker has to write those options, just as a function of making a market, he establishes a position that he doesn't necessarily want to take. So what he will do is he will hedge that position in order to remain neutral. Now, max pain relies on the fact that as the option expiration approaches, more contracts will open and some will close, and the stock price will fluctuate, and the market maker has to rebalance his hedge in order to remain neutral, just because he's shortly going to have to pay out the options he wrote. And so his activity, his hedging activity, will actually provide pressure on Apple stock that drives it towards the maximum pain point. And so how exactly is that calculated? Well, if we look at, say, the 630 strike, if we were going to say that Apple closes at 630, you see we have quite a number of call options that are in the money. You have the 625, 620, 615, all the way down to the 575 and 570s that are in the money. So the option writers will have to pay out a significant amount of call options. They're also going to pay out the 635 puts, the 640s, 645s, a few puts. And so that's what will happen at the 630 strike. If we go over and look at the cash value graph or the max pain graph, what we'll see is if we look at the 630 strike, we're seeing a vertical bar here in green that says, okay, I'm paying out an awful lot of money in call options. It looks to be about $150 million. And you also have a very small amount of put options by this very little red line down here on the bottom. Looking at the other side of it, if you were at the 570s, you'd be paying out an awful lot of money on the 570 puts, well, the 570 put options, and then a little bit on the calls. And where collectively, where the least amount of money is paid out by the option writers turns out to be the 600 strike. So max pain for the week of November 2nd in Apple stock is actually 600 because they're paying out the least amount of cash collectively for that option expiration. And again, that's really due to the hedging activity and the act of rebalancing that hedge as we get very close to options expiration. And that's basically your definition of max pain, and you can find these graphs at MaximumPain.com.